Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
All right, so let's set the table. Yesterday, for the first time ever, Japan's 40-year government bond yield cracked 4%. That's not just a number. It's the death knell for what I've been calling their era of sovereign Ponzi finance. For decades, Japan suspended reality with a central bank cranking out liquidity, pretending risk and return had gone on a permanent vacation. No one wanted to admit how artificial things had gotten. And now, the market is forcing them to wake up hard.
Yeah, it's like for 30 years, anyone with a Bloomberg terminal knew Japan was different, but not that different. Suddenly, it's as if the spell broke overnight. All those policies from the BOJ, just relentless balance sheet expansion, manufactured calm where there was just dead wood piling up and everybody pretending it wasn't going to catch fire. Honestly, Dad, you used to say Japan stopped the clock. And that always felt a little dramatic. But now, I'm not so sure.
No, it was exactly that. I remember visiting Tokyo during the last bubble. Crowds in Korakuen Hall for wrestling matches. Faces in the VIP seats, stone inscrutable, even as the tide was already turning. You could smell it if you paid attention, but they just sat there. That's what the financial system did. Everyone frozen at the party while the floor started to sag beneath their feet. When yields finally move like this, illusions get shattered very fast.
So what set off the fire this time? It was like the classic Minsky moment, except instead of banks overlending to homeowners in the US, it's Japan spending big on defense right as they try to give away tax cuts. The whole guns and butter dilemma on parade. After those major Chinese drills, Joint Sword 2025, Japan drops a record 9 trillion yen defense budget. But at the same time, they want to cut the consumption tax on food. Like, you can't do both. It's not a magic trick.
Right. You try to fund a military buildup and populist giveaways at the same time, the bond market is going to call your bluff. The instant that became clear, yields spiked. Classic Ponzi finance, borrowing new money to pay old interest and hoping no one notices. Well, the world noticed. That's the Minsky unwind. The illusions around Japanese solvency just met fiscal reality, and reality always wins.
I remember, was it Thanksgiving? You hijacked the family dinner to do the guns or butter lesson with mashed potatoes and turkey legs. Mom was less amused, but I got the point. You can't have both. Which is basically what Japan tried, right up until the market started smacking people with the plate.
And then just to drive home who's really in charge, the BOJ came out with this so-called emergency policy guidance. Except all they did was promise to respond nimbly to disorderly market fluctuations, whatever that means, while refusing to actually change their stance. They're signaling, hey, maybe we'll do something, but also nothing's changing. The market's not buying it. Yields keep rising. It's like the referee threw out the playbook and stared at both teams, hoping nobody noticed.
Yeah, and traders just shrugged, or actually they pressed the sell button even harder. When a central bank looks like it's lost the plot, they basically admit they're not the adult in the room anymore. If they raise rates, they risk blowing up their own banks. If they print more money, the yen falls out of bed. It's paralysis, and everyone senses it. I almost feel bad for Ueda. Well, only almost.
Japan's in a corner. Do you throw a punch or turtle up and hope you don't get knocked out? The BOJ's out of easy moves. The yen's exposed. Regional banks are exposed, and the world knows it now. Central banks love pretending they have unlimited levers, but markets don't play along forever.
Of course, tremors in Tokyo travel fast. Suddenly, everyone's glancing at U.S. Treasury Secretary Bessent and his so-called 3-3-3 plan. Deficit to 3% of GDP, 3% GDP growth, and 3 million barrels a day extra oil. Honestly, my spreadsheets just cry when you plug in real bond market volatility. I mean, it doesn't work if your funding costs don't cooperate. And right now they are not cooperating.
Basant can brush it off at Davos all he wants, but the math is what it is. If Japanese selling drives 10-year treasuries above 5%, the interest expense balloons. Those deficit targets just become performance art. Apparently, Basant called Tokyo to calm the market down. When you're relying on the kindness of strangers, or in this case, polite central bankers, you've already lost some control.
It's always the assumption that foreign buyers will show up forever. That dance might finally be over. And all these plans depend on stable funding costs, but that ship is looking less and less seaworthy right now.
Exactly. The big shift here is what I call the great repatriation. For years, Japan acted as the world's anchor tenant in sovereign debt, steadily buying treasuries and corporate loans. Now, as their own yields rise, that capital's coming home. It's not just about the Japanese government. The Norinchukin Bank, giant whale in the U.S. CLO market, has gone from buyer to distressed seller. That's huge for American corporate finance.
When you lose an anchor tenant, the building shakes. It's not just treasuries. Japanese money is pulling out of U.S. commercial real estate too. That's a double whammy for asset prices from New York to San Francisco. Think about it. Less capital sloshing around means it's a lot tougher for companies to refinance or for investors to count on a solid bid under prices.
This is why I always say, forget the central bankers, watch the bond markets. When the big allocators start shifting, the whole macro story cracks open. If the liquidity anchor leaves, everything reprices.
But it's not all gloom. There's a real split here. Domestic sectors are in survival mode, but Japan's robotics, automation, and advanced manufacturing companies, these global IP powerhouses, are looking strong. The so-called currency paradox is fascinating. The yen strengthens, which squeezes exports in the short run, but it actually revitalizes investment in capital goods, which could set up Japan's economy for real, durable growth.
Completely. I mean, a stronger yen isn't great if you're just selling generic widgets. But for firms like Komatsu that own key technologies, it's a different story. Their global relevance grows, even if their margins are squeezed in the short term. That's the kind of company that sees through the crisis to the other side.
I saw a Komatsu demo in Osaka probably 20 years ago. At the time, neat, but not world-changing. Now, those robots are basically the backbone for everything from US factories to European supply chains. I could have never predicted they'd be the heroes in a monetary reset story, but here we are.
So here's the plain truth. The Widowmaker trade, the one the market kept warning about, is here. Investors can't rely on the same old patterns. The global risk-free rate is repricing. Japan's moving toward normality, but after 30 years of distortion, normal feels like disaster. Fixed income, move cautiously. If you're fishing in Japan, focus on exporters with global reach, not domestic cyclicals that are about to get steamrolled by this shift.
Yeah, I've paid my tuition fighting against credit cycles, thinking Japan would blink first. Never ended well for me. Every deal that looked too easy turned out to be a lesson. Look, patience is an edge. Steer clear of chasing yield in the wrong places.
This isn't the end, just a fresh start for real price discovery. Investors need clarity and discipline more than ever.
All right, Dad. Appreciate the tough love as always. And thanks to everybody tuning in. This was Intelligent Investor Insights.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.